The costs of a firm. Firms generate revenue and incur costs. A firm is any sort of business organisation, like a family-run factory, a dental practice, or a supermarket chain. An industry is all the firms providing similar goods or services, whilst a market contains all the firms supplying a particular good or service and the firms or people buying it. Firms generate revenue, that's money coming into the business, by selling their goods and services, otherwise known as their output. Producing this output uses factors of production, and we know that they are land, labour, capital and enterprise, and this obviously entails a cost. The profit a firm makes is its total revenue minus its total costs. In the long run, the firm will need to make profit to survive. Economists include opportunity cost in the cost of production. When economists talk about the cost of production, they are referring to the economic cost of producing the output. The economic cost includes the money cost of factors of production that have to be paid for, but it also includes the opportunity cost of the factors that aren't paid for. For instance, a home office that a business is run from. The opportunity cost of a factor of production is that the money you could have got by putting it to its next best use. E.g., if you run your own business, the money you could earn doing another work is the opportunity cost of your labour. So in economics, cost isn't just a calculation of money spent. It takes into account all of the effort and resources that have gone into its production. Okay, so here's an example. Bill earns £25,000 a year as a plumber for his own business. He also has £10,000 of his own money tied up as financial capital in the business. So obviously there's an opportunity cost in terms of his labour. Instead of working for himself, Bill could clearly get a job elsewhere, and with that £10,000 that he's employed in the business, he could deposit it in a bank. So economists consider profit to be revenue minus accounting costs minus opportunity costs. Accountants are simply revenue minus accounting costs. So let's look at an example. Bill earns £25,000, we've established. However, he has total costs of £5,000. That's accounting costs. Okay, so therefore Bill makes £20,000 a year in accounting profit. However, this is to ignore one thing. The opportunity cost. Bill could earn £30,000 in wages working for a larger company. In addition, the £10,000 he's got tied up into his business could be deposited in a bank where it could earn interest of, say, 10% a year, therefore £1,000 a year. So what is his true costs then? Well, his true costs, the accounting cost of £5,000 we've just talked about, the opportunity costs of Bill's time, which is £30,000, and therefore his opportunity cost of the financial capital, which is £1,000. So therefore his total economic cost will equal £36,000. And just here I've noted that in that case, he's going to actually make an economic loss of £11,000. Point being is here, we're looking at the opportunity cost in the cost of production, and that is 30,000 and the 1,000 noted in the centre of the screen. In the short run, some costs are fixed. In the short run, it's the period of time when at least one factor of a firm's production is fixed. The short term isn't a specific length of time. It varies from firm to firm. For example, the short run of a cycle courier service could be a week because it can hire new staff with their own bikes quickly. But a steel manufacturer might have a short run of several years because it takes lots of time and money to build a new steel manufacturing plant. The long run is the period when all factors of production can be varied. Costs can be fixed or variable in the short run. So, fixed costs don't vary with the level of output in the short run. They have to be paid whether or not anything is produced. They're also known as overheads for a business. For example, the rent on a shop is a fixed cost. It's the same no matter what the sales are. Other fixed costs could include, for instance, installing expensive and bulky capital equipment. On the other hand, variable costs do vary with the level of output. They increase as output increases. For instance, the cost of plastic bags that a shop gives to customers is a variable cost. The higher the sales are, the higher the overall cost of the bags. This is the typical shape of the total fixed costs, the total variable costs, and the total costs. Please note that you can draw the total variable costs and total costs as straight lines. They do not have to curve. Okay, so you can see our total fixed costs here. You can see the total variable costs next door. Let's do that in a different colour. And then you can see the total costs. Simply, we are adding across. So 60 plus 70 is going to get you to 130. 60 plus 120 is 180. That is why we will end up with something that looks like this. So we've got our total variable costs, our total costs, and our total fixed costs. It should be pointed out that all long-run costs are variable because we can alter all the factors of production. Total cost and average cost include fixed costs and variable costs. Total cost is all the costs involved in producing a particular level of output. The total cost, TC, that is, for a particular output level is the total fixed costs, TFC, plus the total variable cost, TVC, for the output level. Thus, TC equals TFC plus TVC. So let's go on to the averages. Quite simply then, average cost is calculated by dividing total cost by the quantity produced. It's sometimes called ATC. So AC and ATC are exactly the same thing. Average fixed cost, simple. Total fixed cost divided by quantity. And again, average variable costs, total variable costs divided by the quantity produced. Marginal cost is the cost of increasing output by 1 unit. Marginal cost is the extra cost incurred as a result of producing the final unit of output. It's calculated by looking at the change in total costs divided by the change in quantity. Okay, so this should be relatively straightforward. There's the change in total costs. And because the output is only changing by 1 each time, the calculations will be very straightforward. So for instance, you can see that between 60 and 130, the increase in cost from producing 1 extra unit was 70, the marginal cost. You can then see that from producing from 1 to the 2 extra units, the increase in marginal costs was 50, and so on and so forth. So you've got here 180 to 240, the difference is 60, and you get the idea of how to calculate. The lowest average cost occurs when marginal cost equals average cost. So let's look at an example of that now. Okay, so marginal cost decreases initially as output increases, then begins to increase in the short run because of the law of diminishing returns. So the MC curve is always U-shaped. Changes in marginal cost do affect the average cost curve. So when the marginal cost is lower, then the average cost will be falling. Okay, so you can see it's lower, as it is lower here. This is because each extra unit produced will decrease the average cost. Adding something smaller than the average will obviously decrease the average. When the marginal cost is higher than the average cost, so we can see here at this point, the marginal cost is higher than the average cost, the average cost will be rising because each extra unit produced will increase the average cost. So the marginal cost meets the average cost curve at the lowest average cost, i.e. average cost will be lowest when MC equals AC. This is productively efficient, and you can see it on the diagram just here. The MC curve also meets the AVC curve, so there's our AVC curve here, at the lowest possible point. So the MC curve meets the AVC curve at the minimum AVC. It should be pointed out that marginal cost is made up of variable costs, so it increases and decreases average variable costs in the same way it does average costs. This means AVC and AC curves also always form a U shape in the short run. They both decrease until they reach a minimum, then they begin to increase. Average fixed costs fall as output rises because the total fixed cost is spread across the greater output. So you can see that at the bottom here, what's going on, and that will go on, I wouldn't say indefinitely, but for a long time, because we can spread those fixed costs over a wider range of output. So here you can see I've got the two columns, average cost and marginal cost. When the marginal cost is lower than average cost, the average cost will be falling. So we can see the average cost is going down 130, 90 to 80. And this is because the marginal cost has been falling. The section in black shows that marginal cost and average cost are equal. This is obviously the productive efficiency point because both of these are equal. In other words, it's where the Nike swoosh intersects with the bottom of the horseshoe shapes. And finally, at the bottom, we have got the point where the marginal cost is now greater than the average cost. So when the marginal cost is higher than the average cost will start to rise. Look, it's gone up from 80 to 100. And this is because the marginal cost went up from 80 to 84. Here's a summary of the notes that I've discussed in the last section.